Imagine trying to sell your house, but the local housing market is completely frozen. I mean, nobody is buying.
Right.
So what do? You set up this secret shell company, you use your friend's money to buy the house from yourself, and then, get this, you charge those same friends a brand new management fee for the privilege of keeping the house off the market.
Yeah, which sounds completely absurd.
It sounds totally absurd, but in the multi-trillion-dollar financial sector, it's not just legal, it's actually the hottest new trend.
It really is.
Yeah.
It's the defining financial maneuver of the last few years.
Yeah.
The underlying mechanics of how companies are, bought, held, and sold have fundamentally broken down.
Right.
And that's forced the creation of entirely new and somewhat controversial plumbing just to keep the whole system moving.
So today, our mission in this deep dive is to explore how the private equity industry is navigating what is essentially a massive exit crisis. Like, how do investment firms actually make their money when they can't sell their companies the old-fashioned way?
Right, which is the big question.
Exactly. And to figure this out, we're pulling from a pretty big stack of materials. We've got a 2008 Cass Business School historical report, some fresh 2026 PitchBook Lemonic research on continuation funds, a 2026 Mark Satin analysis on the UK exit market, and finally a 2025 ICAEW consultation response about tax treatments.
Yeah, that tax document really shows how governments are scrambling to keep up with all this.
Absolutely. Okay, let's unpack this.
Yeah.
Because we are talking about $3.8 trillion of trapped capital and the radical ways investors are trying to unlock it.
To really understand the sheer scale of this trapped capital, you have to look at the historical benchmark. If we go back to that Cass Business School report, the one covering 1995 to 2006, the traditional private equity playbook was incredibly linear.
Right, very straightforward.
The ultimate goal, the way everyone got paid and limited partners, the LPs, got their cash back, was a clear exit. You either sold the portfolio company to a larger corporation, which is a trade sale, or you took it public on the stock exchange.
And private equity back then was essentially a massive pipeline feeding new, healthy companies into the public markets, right? I mean, during that 1995 to 2006 window, PE-backed public offerings accounted for, 27% of the total amount raised on the London Stock Exchange in AIM?
Yeah, nearly 19 billion pounds.
Wow.
And what's fascinating here is the stark contrast and the quality of the businesses that different types of funds were producing back then. The Cass data reveals a deep split between traditional buyout funds and venture capital.
Okay, how so?
Well, when traditional private equity firms, the ones buying established mature companies, when they went public, those companies thrived. They actually outperformed the FTSE All-Share Index by 20% in their first year of trading.
Oh, wow, so they were really solid.
Exactly. The underlying mechanism there is that these were cash-generating businesses. Public market investors could easily value them based on reliable profits.
But the venture capital side of that era was a completely different story. Looking at the data, VC-backed public offerings underperformed the index by 39.3% in value-weighted terms.
Right.
Wait, actually, let's clarify that for a second. Value-weighted terms. Does that mean the larger the company's market cap, the heavier it dragged down the average performance of the whole group?
Yeah, that is correct. The bigger the venture-backed company, the harder it crashed, heavily skewing the overall data downward.
Ouch.
If we isolate just the year 2000, that infamous .com cohort saw a staggering negative 94.3% return.
Negative 94%.
Yeah, they wiped out almost all their value. The public market essentially acted as an aggressive filter. If a business had sustainable cash flow, it was rewarded. If it was a speculative bet with no revenue model, like those early .coms, the public markets aggressively corrected the valuation.
So the public market was the ultimate reality check. And the old private equity model relied entirely on the assumption that this robust public market would always be there to buy the asset when you were ready to sell.
Precisely.
But if we jump forward to the PitchBook Lemonic and Mark Satin data from 2024 and 2025, that reality check just vanishes. The traditional exit market essentially froze solid.
It did. And the primary catalyst for that freeze was the global rate shock. When central banks aggressively spiked interest rates, the fundamental math of private equity just broke.
Because debt got too expensive.
Exactly. Strategic buyers suddenly couldn't borrow cheap debt to acquire companies. And public markets closed their doors to new listings because equities were repricing across the board.
Right.
The PitchBook data really illustrates the severity of this. Cash distributed back to limited partners, the pension funds and endowments waiting for their returns, it dropped below 15% of net asset value for 4 consecutive years.
Let me stop you there because that term gets thrown around a lot. When you say distributions dropped below 15% of net asset value, or NAV, you mean the theoretical on-paper worth of these companies wasn't translating into actual usable cash for the investors?
Right. The general partners, the private equity managers, were sending out quarterly statements saying, your investments have grown. Look at this high net asset value.
Look how rich you are.
Exactly. But they weren't actually mailing checks because you can't distribute on paper growth. To get cash, you have to sell the asset.
And because they couldn't sell, we arrive at the current 2026 backlog.
Yes. PitchBook tracks roughly 32,000 portfolio companies stuck in aging funds. That represents that $3.8 trillion in unrealized trapped capital.
32,000 companies sitting in a holding pattern. I mean, that completely changes the landscape of the broader economy. Today, private equity-backed companies outnumber publicly listed companies by 2 to 1.
Right.
And venture-backed companies outnumber public ones by 9 to 1. Because the exit doors are locked, the median holding period for a private equity asset has stretched out to 7.2 years.
And if we connect this to the bigger picture, holding a company for over 7 years radically alters the human capital equation.
How so?
Well, the Mark Satin analysis on the UK market focuses specifically on this leadership squeeze. In a traditional 3-year hold, you hire a CEO and CFO who are sprinters. Their mandate is aggressive cost-cutting, rapid revenue acceleration, and dressing up the balance sheet for a quick sale.
But you can't run a sprint for 7 years. I mean, you'll destroy the company.
Exactly. You exhaust the organization. Running a business through multiple economic cycles requires marathon runners. Portfolio leadership now demands executives who can manage highly complex stakeholder environments and build sustainable long-term operational value.
So the mechanism of value creation has shifted from financial engineering to actual prolonged business building.
Right.
Okay, but I have to push back on something in this Mark Satin report because it presents a major contradiction. We just established that the exit market is frozen, nobody's buying, but then the data shows that take private activity, where investors buy public companies and take them off the stock market, is booming. They tracked £18.1 billion in UK, take privates in 2025, and another $12.5 billion in just the first 4 months of 2026.
Yeah.
How can the market be totally frozen for selling, but booming for buying?
This raises an important question about market efficiency. The freeze isn't caused by a lack of appetite for good businesses. It's driven by a valuation mismatch.
Oh, I see.
U.S. investors, in particular looking at the UK public markets, perceive those British companies as fundamentally undervalued compared to domestic U.S. equities.
So they're cheap.
Right. The public markets are prioritizing short-term dividends and perhaps heavily discounting UK assets due to regional economic factors. Private equity sees those same companies, calculates the long-term cash flows, and decides they're trading at a steep discount.
So the public stock exchange is shrinking as a place for private equity to sell their existing companies, but it's simultaneously their favorite discount store for buying new ones.
Well said. The public market has transitioned from the primary exit door to the primary entrance, which leaves the original problem unsolved. How do these firms get rid of the 32,000 companies they already own?
Right.
The data shows they're increasingly just trading them amongst themselves. Sponsor-to-sponsor transactions, which is the industry term for one PE firm selling a company to a different PE firm, now account for 62% of all UK PE exits by volume.
Over 60% of exits are just passing the parcel.
Exactly.
But what happens when the music stops? What happens when even the other private equity firms don't want to buy your asset, or you can't agree on a price?
This is the big issue.
Here's where it gets really interesting, because the PitchBook Lumonic data reveals the industry has constructed a massive side door. They call it a continuation fund, or a CV. In 2025 alone, this specific workaround moved $100 billion. That's 43% of the entire secondary market.
Yeah, continuation funds are the critical pressure valve keeping the industry from buckling. To understand how they function, we have to look at what PitchBook calls the three-door choice. When a traditional fund reaches the end of its 8 or 10-year lifespan, the assets must be liquidated. But if the general partner believes a specific company still has growth potential, or they simply refuse to sell it into a depressed market, they will create a brand new fund.
Okay.
The sole purpose of this new fund is to purchase the company from their own older fund.
So let me get this straight. Going back to my earlier analogy, this is like deciding you want to sell your car, but the used car market is terrible right now. So instead of putting it on the open market, you move the car from your left garage to your right garage. You sell it to yourself.
It's a useful analogy, but we need to add the crucial mechanism that makes it controversial. You aren't just moving the car. You are using other people's money to finance the second garage, and you're acting as both the buyer and the seller when negotiating the price of the car.
Right.
When the general partner executes this sale across their own vehicles, they turn to their original limited partners and offer them 3 doors.
The 3-door choice?
Exactly. Door number 1, cash out right now at the newly negotiated valuation. Door number 2, roll your existing stake into the new continuation fund. Or door number 3, roll your stake and commit additional fresh capital to fuel further growth.
But wait, if the general partner is both the buyer and the seller, who actually decides the price the limited partners get cashed out at? Surely they can't just pick a number.
No, the GP typically secures a fairness opinion from an independent investment bank. Mechanically, a third-party analyst reviews the financials and signs a document stating the proposed price is fair to the investors.
Okay, that makes sense.
However, the LPs only get a 20 to 30-day window to evaluate this incredibly complex transaction and make their choice. Furthermore, if they choose to roll into the new fund, they are signing a new limited partnership agreement.
And here is the kicker for the investor's pitch book notes, that this new agreement usually comes with a fresh 5-year lockup period and new management fees of 50 to 100 basis points.
Right.
In plain English, if we are talking about a billion-dollar asset, 100 basis points means the investors are paying the general partner an extra $10 million a year just to keep managing the exact same company they've already been managing for a decade.
The clock resets and the fee structure resets, and the scale of these vehicles has exploded. Initially, we saw multi-asset continuation funds, where several companies from an older fund were bundled together.
Like when Leonard Green rolled its stake in Restaurant Depot?
Yes, exactly. But the market has shifted aggressively towards single-asset CVs, which now make up 53% of the transaction volume. These are supposedly the crown jewels. Vista Equity Partners, for example, orchestrated a massive $5.6 billion single-asset continuation fund just for the cloud software group.
One company, nearly $6 billion, moved from the left pocket to the right pocket.
And the market is pushing the boundaries even further with what is known as a CV squared.
A CV squared.
Yeah, this occurs when an asset outlives its first continuation fund and is rolled into a second one. PAI Partners executed a CV squared with an ice cream company called Ferneri. When you stack these vehicles, a private equity firm could end up managing a single asset for 15 or 20 years.
Just continuously generating new fees without ever exposing the company to the public markets.
Precisely.
But surely the limited partners, the sovereign wealth funds, and massive public pensions who actually hold the purse strings are doing the math on this. If you tell me my money is trapped for another half-decade with a new layer of fees, I'm taking door number 1, give me my cash.
That is exactly the dynamic playing out right now. The PitchBook data details a severe LP rebellion against this structure. Public pension funds are simply refusing to participate.
Oh, really?
Yeah. In 2018, when continuation funds were a novel concept, public pensions chose to roll their positions into the new funds roughly 30% of the time. By 2024, that roll rate plummeted to a mere 2%.
Wait, a 2% roll rate? If these single asset CVs are supposed to be the absolute best companies, the trophy assets, why are the most sophisticated long-term investors in the world sprinting for the exit?
Because the underlying performance data doesn't justify the fees. PitchBook highlights a glaring gap in the projections. When general partners pitch these single asset CVs, they typically underwrite a target return of 2.2 times the invested capital.
So they promise the asset will more than double in value.
Right. But the realized median return for these vehicles is currently sitting at only 1.4 times. The fundamental reason for this underperformance is that the easy operational fixes, the cost-cutting and low-hanging revenue growth, were already extracted during the first 5 years of ownership.
Ah, that makes sense. Generating exponential growth in year 9 or 10 is exponentially harder.
Exactly.
And it isn't just about underperforming. The PitchBook research shows that these vehicles are failing their first real economic stress tests. We are seeing actual bankruptcies inside continuation funds.
This is where the structural risk becomes violently apparent. Clearly Capital put an automotive aftermarket company called Wheel Pros into a $2.3 billion continuation fund in 2021.
Okay.
By late 2024, the company filed for Chapter 11 bankruptcy, and the CV equity was wiped to zero.
Let's clarify what equity wiped to zero actually means in this context. The general partner's ownership and the investor's money in that fund evaporated. Because the company's debts exceeded its assets, The debt holders essentially took the keys, leaving the continuation fund with nothing.
Exactly, the mechanism at play. We saw a very similar destruction of value with United Site Services,
Yeah.
the Platinum Equity CV, where the sponsor equity was also wiped.
Wow.
High leverage carried over into a high interest rate environment leaves zero margin for operational error. When growth stalls, the debt consumes the equity.
Right.
And this environment is inevitably leading to friction and litigation. There's currently a major lawsuit in the Delaware Chancery Court between the Abu Dhabi Investment Council and Energy and Minerals Group fighting over the pricing and LP rights within a continuation fund structure.
So we have a situation where capital is trapped, assets are missing their performance targets, bankruptcies are materializing, and the pensions are walking away.
Yes.
Naturally, when billions of dollars start moving through novel closed-loop financial structures, the government is going to start asking questions. Which brings us to that fascinating consultation document from early 2025.
Right. As holding periods stretch and firms rely heavily on these complex continuation vehicles, the UK government launched a consultation to reevaluate the tax treatment of the industry.
And we can look at the formal response submitted by the ICAEW, which is a major professional body for chartered accountants in the UK, to see how the industry is defending its mechanisms to HM Treasury.
Yeah, the core of the debate is around carried interest.
Now, for you listening, carried interest is the share of the profits that the private equity managers get to keep after they clear a certain return hurdle for their investors. It has historically enjoyed favorable tax treatment, often taxed as capital gains rather than standard income.
Which is obviously a massive financial advantage for the fund managers.
Yeah.
So the Treasury was exploring ways to tighten those rules, specifically looking at minimum co-investment requirements and minimum holding periods.
Right.
The ICAEW's response provides a highly technical defense of the status quo. Regarding co-investment, the idea that managers must put their own money on the line to get the tax break, the ICAEW argues to the Treasury that government regulation is redundant here.
Because the market already handles it.
Exactly. Institutional investors already strictly demand that fund managers co-invest. It is a market-enforced prerequisite, not something that requires new tax legislation.
And what about the holding periods? I mean, if the government is concerned that private equity is just passing assets back and forth to generate fees, it makes sense they'd want to mandate a minimum holding period to ensure managers are actually building long-term value before they get a tax break.
The ICAEW counters that argument by pointing out the existing mechanisms already cover this. Current income-based carried interest rules already mandate that if a fund's average holding period is less than 40 months, the profits are taxed as regular income anyway.
Ah, I didn't realize that.
Yeah. The accountants argue that slapping an additional minimum holding period on individual fund managers, rather than the fund itself, would create an administrative nightmare and severely restrict job mobility within the financial sector.
And crucially, as it relates to continuation funds and these aging, decade-old investments, the ICAEW draws a hard line in the sand regarding existing contracts.
Yes, they forcefully stress the absolute necessity of grandfathering existing tax entitlements.
Right.
When a private equity fund is launched, the level of co-investment and the precise rules for distributing carried interest are locked into legally binding partnership deeds.
And those were signed a long time ago.
Exactly. These documents were negotiated and signed, in many cases, 10 or 12 years ago. The ICAEW points out the mechanical reality. You simply cannot retroactively apply new tax frameworks to existing partnership deeds without triggering catastrophic legal and administrative chaos between the GPs and their global investors.
So what does this all mean? We started by talking about a housing market that completely froze, forcing people to just sell their houses to themselves to keep the lights on. We've seen how the private equity industry moved from a golden era of ringing the bell at the stock exchange to a modern era where companies are held hostage by high interest rates for over 7 years.
Yeah.
The exit pipeline is clogged, so firms are passing assets to other PE firms or locking them into continuation funds to reset the clock and the fee structures. And according to PitchBook Lumonic's forecasts, this isn't a temporary glitch in the matrix. They project the secondary market could hit $400 billion by 2030.
Right. These side doors aren't workarounds anymore. They have become the permanent load-bearing infrastructure of the private markets.
The plumbing hasn't just backed up, it has been entirely rerouted. The holding tanks are becoming permanent fixtures of the global economy.
They absolutely are.
Which leaves you with a really provocative question to think about. If the public stock markets keep shrinking and private equity just keeps rolling companies into new continuation funds or selling them to other private equity firms in this endless closed loop, Do we eventually reach a point where the ultimate buyer for every major company is just another private equity fund?
It's a real possibility.
And if the assets never actually leave the private ecosystem, how does the real economy ever discover the true objective value of anything ever again? Because if the house never actually goes on the open market, how do you know what it's really worth?
That is the multi-trillion-dollar question the market is trying to answer right now.
Something to mull over the next time you hear a company is being taken private.